Good afternoon, ladies and gents, and welcome to our webinar. We'll be getting started in about 5 minutes. So in the meantime, we're just going to launch a quick poll as we still get some of the attendees flowing in. Again, please feel free to introduce yourself in the chat. So again, our theme for today is all about diversified portfolio. So we'll launch a quick poll right now. If you could take your time answering that. And again, it's just about diversified portfolio. Do you have a diversified portfolio? You know, just so we get a gauge of where the audience is. All right, looks like we've got quite the results are really starting to come in now. It looks like the majority, about 50%, do have a diversified portfolio, with a few not knowing what a diversified portfolio is, and others not choosing to have a diversified portfolio. Right, we'll let that poll run as we get the attendees rolling in. Just a few housekeeping rules by the time this poll ends. So again, before we do a brief introduction on who Finimize is, just a few housekeeping rules here. Again, any information presented in this is for educational purposes only. Nothing is intended to be taken at face value, but again, it's starting the discussion and educating the viewers. In case you didn't know what Finimize is, it's a great app that provides what's going on in the markets on a weekly, daily basis. You know, really condensing what you need to be keeping an eye on, trends that are starting to emerge, and they've got a lot of great content out there. Especially when you have really busy days, when a lot of things are going on in the market, it's really useful to have a nice, quick, brief summary of what's going on and the main points that you should be keeping an eye on. So just a brief introduction on who we'll have today. I'll be your host, Kamajit, also known as Cam. We also have with me Brandon and Brian Dunhill. Right, it looks like we'll just end the poll here. It looks like very much the diversified portfolio Yes Camp has won hands down. So there's the results there. Right, so let's jump right in. What is a diversified portfolio? And with that, let's introduce Brian.
Hello, everybody. And first, I'm going to take us back for a second. Happy Veterans Day to everyone. If anybody's a veteran on this call, please take my gracious thank you. If you know any veterans, please extend out your thank you for their service and everything that they do. Well, today we're going to be talking about different portfolios and what is a diversified portfolio. It's an odd time with negative interest rates to say we should have a different percentage in stocks and bonds, because especially when you look at the bond market, compare it from last year to this year, all of a sudden the credit ratings have shrunk significantly as everybody's increased their balance sheet and the amount of debt they have on their balance sheets. So all of a sudden we should be looking at diversification in a different way than we did in our textbooks. And that's to where diversification becomes key towards not being fully correlated to one mechanism. Not being fully in the tech market if we're in the stock market, not being fully just in 10-year treasuries, i.e. that old Warren Buffett phrase of just buying 90% in the S&P 500, 10% in 10-year T-bills, and you'll be fine. You will be fine, but you could do a lot better by adding other positions around it.
I mean, we've all heard the expression, not to keep all your eggs in one basket, and I think many of our audience might be familiar with that. So we've talked a bit about, how a diversified portfolio can actually benefit the investor. So let's just jump onto strategic allocation. What is strategic allocations?
Well, strategic allocation is what we've really heard about in our financial planning textbooks. You probably have seen a nice diversified portfolio that looks like this, where all of a sudden you say, I'm going to have this percentage in stocks, this percentage in bonds, breaking it down further into the pie chart, into the different regions, and then going down into sectors and then selecting the individual stocks. These are the rough breakdowns of our strategic allocations when it comes to currency and natural hedging. So you see that there's a wide difference between a client that's retiring in Europe versus the UK versus the US. But in those strategic allocations, it doesn't consider that at certain times, we know that certain sectors are going to perform really badly. That being said, we know when interest rates start moving up, which Monday might have been that precursor. We saw the yield curve expand significantly on Monday to where all of a sudden banks started to look like they were potentially profitable again. Interesting segments in there. And if we continue to see interest rate increases, we could expect the bond side of our portfolio to perform very badly, considering that we've had since 1982, the interest rates have been going down. If interest rates start moving up again, that could all change. One day, not really reflective of a huge change when we're comparing it to 38 years, but we have to be mindful that from negative rates, one day we will have positive rates again. And one day we might actually see some inflation, and therefore those rates could go much higher. So we want to avoid some of those pitfalls in a strategic allocation.
No, definitely. I mean, even Monday and Tuesday, whilst I was looking at some of the charts, when we saw the 10-year start to flirt with the 1% yield level, as investors, sold off their bonds to jump into the market, and we saw quite a few names, up 10%, double digits nearly, in quite a few of those, those growth and value sectors and opening trades. I guess the other question is, when it comes to strategic allocation, why should investors, be mindful of where they're living and how that determines what they should invest in, and I guess more to do with the natural currency hedging?
Great question, Cam. And this is one of the foundations of what we do for most of our clients. Most marketplaces are cyclical. So for instance, if you're in the stock market, we know that even if you have a bad year, 3 out of every 10 years, we're going to have bad years. As long as you stay invested in the market, it will come back and right itself. Currency markets are no different. If a currency gets weaker for a period of time, essentially we would expect it to rebound later on because that weak currency would help it grow its GDP. The main factors that drive currencies are monetary policy, fiscal policy, and growth rates. So when we start equating that growth rate, a weak currency should increase the GDP and that growth rate to help improve it with time. The problem is that cyclical basis can take a lot longer than it would in the stock market or the bond market. A lot of the studies will show 20 to 30 year trends in one direction for a currency. For example, it's been since the financial crisis that we've seen euro strength, but we can go all the way before the euro was established, all the way back to the origination of the ECU, of thinking of euro strength versus the dollar, i.e. Nixon going off the gold standard got us into this long-term trend of dollar weakness. So if you have a 30-year trend where the dollar and the ECU started roughly at parity, and then all of a sudden we got into the 140 somethings, if over the course of your retirement savings over 20, 30 years, you forgot to factor currency into the equation, and therefore you lost 40% of your value, you'd be very upset at your financial advisors. So an American that intends to retire in Europe should be thinking of investing in euros and thinking of those types of investments over the long haul so that they can minimize that currency risk. Now, sometimes that means you lose some of the trends, like Europe naturally doesn't have the fangs that the United States has. So you don't want to eliminate them completely. But as we've seen in the last couple of years, we're starting to see a lot of those tech businesses coming along in Europe. Allegra out there in Poland. We have Spotify up in Sweden. Now we have a potential competitor in the search space up in Sweden as well. So we're getting a lot of investment on the tech side that could be competing with the FANGs, and therefore the next chapter could be on the European side. But basically, by owning our currency, we minimize one of those risks in having that diversified portfolio.
No, definitely, I think currency is one of the things that a lot of investors overlook when it comes to building a diversified portfolio. You know, they have their sectors, they have their cyclicals, defensives, but they sometimes forget about the currencies. Again, we have a couple of questions, so ladies and gents, please feel free to keep them coming in. We will be having a Q&A section towards the end. So we've talked about the strategic allocation. So let's move on to core plus satellite. What is a core plus satellite model, and where did it originate from?
Yeah, so core plus satellite is it's a portfolio concept that Goldman Sachs came up with years ago, and the entity of the core plus satellite solution is that the core of our portfolio should still be set in a strategic allocation. If you look at any of our portfolios, the majority of the positions are still your S&P 500, your Euro 50, your emerging market mainstays, and our bond allocations. But we will allow in every single one of our portfolios to have up to 20% of our positions in what are called satellites. Now, at the beginning of the year with COVID, we made a simple move. We sold all of our real estate in our portfolio and we put all that money into e-commerce. Our Amazons, our Mercado Libre, our Alibabas, etc. Now, looking back on it, this is an obvious move. If you close down all the stores and people have to buy on e-commerce, well, those companies are going to do wonderfully well. And some people will say, well, Amazon's too expensive now. But in simple form, they've doubled their revenues, even more so now. So therefore, if they're too expensive today, they were too expensive last year before the crisis. So these become obvious trends. They don't take over our entire portfolio. They don't take over that core of the portfolio. They become those satellite positions that we can have up to 20%. We have a cartoon video where Cam astutely says right at the end, you know, our goal would be to have 0 satellite positions in normal times. I miss those normal times. And that's the truth. There's normally always a position that we can find that hedges our portfolio in a little bit better way. And I think that is the more important function of satellites. Sometimes you get to sell real estate that you feel is not going to do too well and buy e-commerce that does extremely well, like we did this last year. But the last couple of years, we started building our first position in gold. First time we've ever had a position in gold. Now we're even adding to it in silver and buying renminbi, i.e. the Chinese currency-based positions. Now, all 3 of these positions are not out of greed, out of trying to get excess performance in those positions. All 3 of these positions are basically currency hedges in our portfolio, because we know the dollar has had a great run and it is really, really expensive. There's only three currencies that are more expensive than that: Norway's, Sweden's, Switzerland. So the majority of currencies are actually much cheaper, and things should revert back to those norms as we've talked about earlier. But essentially, we know that we expect the dollar to go down in the next 3 to 5 years. At the same time, we have Brexit coming in whatever form it's going to be in the next couple of months. And therefore, we wouldn't expect the euro or the pound to be going into a strengthening market. Commodities are starting to come off their bottom, and if we can get a good recovery, that things showed that way from this vaccine on Monday, well, we could expect the Canadian loonie and the Australian dollar to start to rebound as we have in the last couple of months. And even more so, we could see the renminbi do well. But commodities shouldn't do well if we have a recession. And while we've already gone into recession, if we stay in a long-term recession, people buy less commodities, so commodity-rich currencies shouldn't do so well. So where do we go? Well, we go into a hedge with gold and silver, which, as you have seen, they've done quite well. I, long-term, don't want to have gold in my portfolio. It is an inflation hedge, it is a currency hedge, but long-term, it's a commodity that you hardly use for anything. Silver, you can use a little bit more for it, but still not something that I'd like to have in the portfolio long-term, but a wonderful hedge when we're looking at our three most solid currencies and basically putting our hands up saying, we don't know which one's going to do worse. We just know that we're pessimistic and bearish on all three.
I think that's a perfect segue into our next poll, again, about satellite position. So we'll be launching a quick poll on what's your favorite satellite positions, if you do have any. So let's see if we get any answers strolling into there. And whilst the audience is selecting their options there, I'd like to touch upon a topic, if you don't mind, Brian. So we've discussed the whole core plus satellite approach, and most of our investors and audience here are of the passive nature. What are the benefits of, as you said, having 80% of your portfolio being that passive core, and then having slightly tactical shifts, being underweight in certain sectors, overweight in certain sectors, in the long run, how is that beneficial to investors?
Well, there's many advantages to that. For instance, I don't think many people knew about Pfizer's announcement on Monday, and yet it moved the markets. We shifted 5% on the upside for the overall indexes. The simple math comes down to the fact that the best traders out there, this is Peter Lynch's quote, by the way, I'm just going to plagiarize it. The best traders out there are only right 60% of the time. So if you have to be right, the right time to buy, the right time to sell, 60 times 60 comes out to 36%. Whereas, like I was saying earlier, if we buy and hold, we're right 70% of the time, i.e. 7 out of every 10 years. Which one would you prefer to be? 36% if you're the best of the breed, or 70% by buying and holding. So the advantage of buying a passive index and owning it for the long term is that those companies that aren't doing so well fall out of the indexes. A couple weeks ago, we had the big news that the ExxonMobil, the oldest company in the Dow Jones Industrial Average, was getting kicked out. To add, I think it was Salesforce, but you'll correct me if I'm wrong there.
I think we had Raytheon as well get kicked out of the Dow Jones.
So all of a sudden there is a rotation, but it's a slower moving and non-emotional rotation to where we're owning in the S&P 500. We prefer buying the KLD 400, which is the socially responsible index. A couple of reasons. First of all, because it's the right thing to do. If you invest in companies that are doing the best thing for other people, for the world, all of a sudden, it's not surprising that they get better returns than those that can't see past the end of their nose. Second of all, oil prices, they've tanked for the last 10 years. So you remove oil stocks from the portfolio, and essentially, you can't be surprised that 1 year, 3 year, 5 year, 10 year, the KLD 400 outperforms the S&P 500. So simple, be socially responsible, and all of a sudden you're going to outperform those other indexes. Commodities go straight through the roof. I'm totally wrong on that. We're totally fine with giving up on that because we don't find that many of those companies are run for optimal long-term gains, and we're fine with being wrong on that. So going back a little bit on that, the passive nature also helps us significantly from a tax perspective. A lot of people on this call might be internationals that are living in a second place. Most of our clients are Americans that live outside of America, so they'll be subject to double taxation. And by not shifting the portfolio so often, we avoid capital gains. And capital gains taxes are like taking 2 steps forward and 1 step back, and then 2 steps forward and 1 step back. So trading too much in our portfolio can affect more taxes, more costs, and more risk.
Exactly. It's timing the market, not timing the market at the end of the day. So we've got the results coming in. I'm just going to share the results here really quickly. It looks like, we have 35% of our audience that, really like e-commerce stocks as part of their satellite positions. But the clear winner being technology stocks, although I would argue both of them are sort of interchangeable at times. We have a few audiences select fintech and SPACs. I guess we do have members here with a slightly higher risk appetite here, but that is quite the interesting find.
It's also great to see some people investing in the commodities markets. Those have been shifting and are naturally going to be controversial going forward in a good way. So yeah, it's a good mix amongst the crew. I see Joe's question. It's not that Spotify is a competitor. Spotify is the European company that is the biggest European tech company, naturally behind some of the German staples out there, but one of the good high flyers in Europe. So all I'm making there as an example is that the Allegra IPO in Poland is starting to make this push towards more large-scale investments in Europe amongst the tech crew.
I think just to round up this section here, let's jump in a bit about currency sectors and the whole debate between growth versus value. I think, especially the latter, growth versus value, in the past couple of days alone, that's sparked quite the debate, with some of the FANGs being sold off and, the NASDAQ taking a hit, whilst a lot of the value-oriented indices, enjoyed, 5 to 6% gains. So what are your thoughts on that, Brian, if you could add a bit?
Well, essentially, we've had a value trap for a good long time. and I think essentially there are lots of great companies out there that are of great value, but some of them are a COVID bet. So naturally, the best performers on Monday were not your Pfizer. I mean, Pfizer was up, but it wasn't by any means the best performer. Your best performers were the airlines, the hotels, anything that could really take off the minute that this crisis is over, that this pandemic is over. So naturally, if you're betting that COVID is going to disappear, that is where you should be playing, not in the pharmaceuticals. Our best examples, we've always said, the pharmaceuticals in China didn't do so well after the SARS epidemic. We've had 9 epidemics and pandemics in the last 20 years. So when these politicians, when they say, oh, well, this is unprecedented, well, that's them saying, I take no responsibility for the stupid things that I'm doing, and you guys are gullible enough to believe me. Well, there's plenty of research that you can do of exactly how markets react in different situations. And for all of you, when 44% of you are answering technology stocks, well, technology stocks are not only the stocks that do the best during these crises, but they're the ones that do the best coming out of the crises. Hence why we've been overloaded in tech stocks. That being said, what Cam's bringing up there was Monday the beginning of the rotation out of the tech stocks? We've noticed a little bit of weakness the last couple of days on that trade. And naturally, after that, well, we have some big news of Europe going after Amazon. And we know that the Biden administration is going to look at all of these companies, all of the FANGs, Facebook, Apple, Amazon, Netflix, Google, and say, should they all be combined as singular companies? Now, I know that Cam and I have had many discussions of whether the valuation of the breakups of the FANGs will be beneficial to the stock market. And I'm a firm believer that if all of a sudden we're able to decide which of the alphabet, i.e. Google companies, we want to invest in and which ones we don't, there's going to be a lot of them that we'd just sell out of the portfolio if it was divided up. So I'm using the precedent of AT&T and Standard Oil, i.e. where Exxon came from and Rockefeller, being examples that if you split these companies up, they're worth a heck of a lot more as pieces rather than as a conglomerate. We've seen the conglomerate effect kill Citigroup's stock. It's killed GE's stock, and both of them have been spending more than a decade unraveling the buildup that they built over decades, killing the legacies of some of the men that put those together. So I'm of the mindset that they'd be worth more when you look at that waterfall transaction if I could buy just the one piece that I wanted to instead of having to buy the whole thing. I don't think anybody looks at Alphabet and values the fact that they have a self-driving car model inside of their company. Yet outside of it, it doesn't matter if you push your truck down a hill, people will pay tens of billions of dollars for it. So, there is a lot of unleashed value there that a lot of people are viewing as risk. I'm viewing it as potential great opportunities, and to finally not have to be talking about the fact that we have less stocks every year on the US stock market and therefore less to select from, and therefore we should be going into private equity. No, there's new opportunities coming out every day. It's figuring out how to value them. Getting back to the original question of growth versus value. Well, essentially, I'm looking at value in a different way than I ever have before. Because if I typically go into the typical, there's a company that has a great dividend. Well, that means absolutely nothing to me, because take Exxon. I've heard people defend it a lot over the last couple of years to say, oh, but look at their dividend. It's had a consistent history of tens of decades to many decades of increasing their dividend every single year. Well, that doesn't mean anything to me, because if you look at the last couple of years, they've increased their debt to continue paying their dividend. It's not coming from free cash flow. You can only do that for a certain amount of time, and that is dependent on oil prices going up. So I don't want a financial mechanism that is overwhelmingly based on low interest rates and essentially expanding commodity prices, because I can't guarantee you that we're going to get to that. There was a wonderful article this morning in the Financial Times that basically said America could be over 50% renewable energy by 2022. Now, I felt like I hadn't done my homework in a while, because that seems really close. Right. That's just a year, that's an election away for Congress. Mm-hmm. Essentially, I'm not looking at those value stocks in that same way. I'm looking for all of you passive investors on here. Cam said there was a lot of you that were investing passively. Passive investing gives us great opportunities to find great little satellite positions. We essentially know that we had a huge sell-off in small cap US and emerging markets at the beginning of this crisis. Simple reasons why. Small caps tend to have a lot of debt, so people wanted to get out of overly indebted companies, and emerging markets were naturally going to get hit the hardest. Going back to past examples, the Spanish flu killed off 50 million people in India alone. It was the worst part of the Spanish flu. So India was easily going to be the hardest hit by this crisis. Luckily, they haven't, because in demographic terms, Japan's the oldest country, Europe, the United States. Japan, the average person's around 48. Europe, United States, around 37. Well, India, 27, 28. So by having a younger population, they haven't been hit as hard as they could have been. And therefore, it hasn't affected their economy as much as it has affected ours. But emerging markets and small caps got sold off in a big way. So what do? We start digging through those trenches, and we basically say, biotech, tech company, over-indebted, throw them out. Egg farm with very little debt that hedges our inflation risk, love it. We love it. Again, it's because it's a hedge. Sorry, I'm going to digress on another story. You look at inflation being a risk, but deflation is also a risk. So we're not predicting one way or another. But if we have inflation being a huge risk in our portfolios and deflation being a huge risk in our portfolios, what do we invest in that we can hedge that? Well, we looked at a grocery store. Typical grocery store has about 110,000 items in that grocery store. Of those 110,000 items, the one that never moves with inflation, i.e. if we were betting on deflation, are potato chips. They never increase in price. Potatoes are cheap. They change the amount in the bags, but they never increase the price. So you can go out and buy Frito-Lays, you can buy any of the chips companies if you're predicting deflation. Now, on the other side, if we're predicting huge amounts of inflation, blueberries. Blueberries are the item that grows the most with inflation. So there's a company out, I think they're in Arizona, but it might be New Mexico, out there in the states that flip blue. Essentially, there's a company called Snack, S-N-A-K. They do both potato chips, but they own the most blueberry farms in the United States. So that's a great way to be able to minimize if you're predicting inflation. Much better performance than buying tips. Now, we're not in the mindset of saying inflation is going to be rampant. It should be when I look at my textbooks, but I think the theme of the day is that the textbooks need to go out the window a little bit and we need to adjust them. We need to adapt to the fact that these are weird times and therefore we don't want to own certain sectors. We're also looking at deflation as, okay, hopefully we don't go into that. Modern monetary theory is, well, pretty ridiculous as a concept for the long term, but deflation becomes that risk that we could get from that concept. So we started looking to say, what's the item that grows with inflation? And the answer is eggs. Eggs grow 1-to-1 with inflation. So we've bought Calmaine, C-A-L-M, which is the biggest egg farm in the United States. And the odd thing is, it's hardly moved because in the small cap arena, it's in all of those passive groups. But when we look at egg prices during this crisis, they were 97 cents before the crisis started. They got up to $3. So when we're getting all these CPI indicators, they're saying there's no inflation. Well, why are egg prices moving so much then? I can't answer that question. You know, I'm just saying that to me is a nice way to hedge buying in an oversold company. We had some news from one of the family members that on one of the highs, she or he, I'm not sure, dumped out a lot of her shares. So it's on a little bit of weakness. Those are opportunities. That's value. In the emerging market space, we found lots of opportunities, especially every single time Donald Trump opened his mouth and it moved the Chinese stocks. We know that China is going to be a big player in the long haul. We don't know whether that's going to be 1 year, 3 year, 5 year, 10 year. But we know that China is going to be a big player and that the renminbi has been going up since April. You'll correct me if I'm incorrect on that.
I think somewhere around April when people started selling off the dollar slightly. So
we've gone from a lifetime of saying the renminbi is devaluing, they're cheating on their currencies, et cetera, so that they could produce a lot of manufacturing. We always figured that they would start to essentially not devalue their currency when they got to about 80 to 85% service economy instead of manufacturing economy. Well, they're around 70% right now. And what we're factoring is, well, they have the opportunity to get on the global stage. So they're going a little bit early. Now, they tried the same thing back in 2008. So again, you know, this isn't unprecedented. We know exactly what China wants, a seat at the table. And they will get a seat at the table because they're a huge economy and they do things right. So what are we doing? Every time that Trump makes an attack on China and we get a sell-off in Chinese stocks, all of a sudden we're basically saying, we'll take some of that. Even in the entire Asian region down there in Southeast Asia, there's some great opportunities to buy into individual companies. Would not want to basket the entire index, but some great individual names over there.
I think that's a fascinating way to look at, you know, especially the inflation deflation debate. You know, I think I would have never guessed that eggs is, you know, one of the items that grows lockstep in inflation, and you know, that's a fascinating insights. But I guess we'll move on to our next guest here now. And before we do that, I'd like to segue into our next poll, which is slightly relevant. So slightly off topic here, but again, bear with me and we'll probably explain it a little bit more. So the next poll is about what are your favorite regions when it comes to wine? again, it might seem a bit out there, but again, all will be made clear in due time. And whilst our audience is very much taking those questions rapidly, I'd like to introduce our next speaker. I'd like to introduce Brandon Michener, born and raised in the United States, and then having lived in Europe for the past 30 years. Very much the diverse man, having studied and visited in Germany, Switzerland, and Austria. Brandon also worked as a journalist for various news outlets such as the Wall Street Journal and many others, and now having taken an interest in wine, hence our question, with his new venture in Finimize. Again, apologies if I butchered that Italian pronunciation. So again, I'd like to welcome Brandon. And before we do anything else, and before we dive into anything else, with a name like that, surely there has to be a story behind it.
Yeah, well, thank you for the introduction, Cam. So basically, you close on the pronunciation. It's terre, mieli, celli. So wine is basically a labor of love for me. It's not my full-time job. It's something that I do on the side, but may be an exit strategy from the corporate rat race one day, or a retirement plan. But I've loved Italy for many, many years, and I was married to an Italian for 20 years. I spent many, many vacations in Italy, speak Italian quite well, and so Terra Mieli Gelli is basically, in the name, in the choice of the Italian name, even though it's very difficult for everyone to pronounce, believe me. I said, okay, I'm making a statement there. And the second is the words actually are relevant, I think, both for wine, and you could also argue for investment. So terre means the earth. It's about the terroir, is often used to describe Burgundy, in particular French wines. It's the part of the earth and the land, the nature of the hill that the wine is growing, that the grapes are growing on. The celli is the sky, so that's the element of luck that comes in. Do you have good weather that year, bad weather that year? It makes a big difference in the end result. And then mieli speaks to the products of the land, the products of the fruit of the labor of the guy making the wine. And mieli just means honey, so it's symbolic of all things good and sweet that come out of the combination of good fundamentals and good luck.
That's a very interesting story. I wouldn't have thought of that.
Probably
it looks like our it looks like our polls have finished. I'm just going to share the results for that before I let Brian take over the next segment. It looks like 27% of our audience prefer the French region when it comes to wines. Second place being Italy, and then naturally the New World. We've got 19% of our audience sort of interested in the New World, especially when it comes to wine, followed by Spain, and then a lot of people don't actually drink. So we've got quite the mixed bag here.
Yeah, no, that looks good. In fact, it's, I think, fairly reflective of the wine market in general. I mean, France and Italy do dominate the European exports. US wines, and California and Oregon wines in particular, dominate the Americas. So it makes, it's no surprise at all that you would see that those are what people like. And I'm sure you put Portugal and Greece there, not by accident, but because they're, I'll talk about that later as well. I think they're close to my heart in terms of what you can find in terms of value wines. And so basically, thank you for flashing this up. So my store there, it's the wine shop, and where I organize the virtual wine tastings. I specialize in Greek and Italian, and I'll soon be adding some Portuguese and Spanish wines as well. So I purposely don't focus on French wines, not because I don't like them, but because I find they're generally not good value for money for drinking. I'm not talking about investing yet, but for drinking. You get much better value, particularly from Greek and Portuguese and New World wines than you do from the French wines. The second reason is that I live in Brussels, Belgium, and the market here is completely dominated by French wines. So again, talking about drinking rather than investing, I can't compete with the supermarkets, and I don't try. I try to focus on things that people here don't know at all, including Greek and Portuguese and some more obscure Italian wines.
Mm-hmm. Right now, we've got a bit of background. Yeah.
Sorry, go ahead, Kim.
And so let's just tie this all in, just so our audience isn't left a bit confused on what are sort of the similarities between wine and in different investing styles, and how do we tie this all together? I'll let you take the floor, Brian.
Yeah, no, it sounds like the perfect analogy to exactly what we were talking about. You're looking for those outside pieces instead of the most important aspect of, oh, we all know who the FANGs are. We all know Facebook, Apple, Amazon, Netflix, and Google. And probably most of the people on this call own a little bit of stock in there. Most of the people on the call know their French wines. So those favorite regions, give us some insight on which values we can find, which value wines we can find versus those growth wines.
Well, the first question everyone needs to ask themselves and be honest and truthful with themselves is, what do they really intend to do with that wine? If it's really just for investing, then there are some simple principles, I think, which are the same for lots of investments. You want to go for blue chips, which in the wine world means names you've heard of. It'd be like Chateau Lafite, Chateau Latour, Châteauneuf du Pape, Haut-Brion, Romanée-Conti, those kinds of things for French wines. Because you know that they benefit from the name recognition, from the scarcity value, because the production each year is limited, and they do that on purpose as well in order to keep the values up. So one thing is to look for this kind of blue chip name. Another principle I would say, though, that you've already mentioned is asset allocation and diversification. You shouldn't put all your eggs in one basket, because if you want to be a serious investor and buy from the same producer or the same region every year, you may end up with a bad year. Honestly, there are some years where you just shouldn't buy Bordeaux. So therefore, what you want to do is diversify a bit and at least, buy things from different regions of France. The Rhone Valley has much better value than Burgundy and Bordeaux. And then you can buy champagnes as well, which can last longer than people might believe. So that'd be going for the blue chip brands, the diversification, and then do your research on the year. So just like buying any good stock, you want to make sure that you've bought something which is going to last.
I'm going to incite one of the few wine stories that I have on you. You mentioned Haut-Brion. And as you might have noticed, Brandon, from our History of the U.S. Presidents video that we put out on election night last week, it's scary to think that it's already been a week, that I quite like American history. And as you might know, Jefferson was our first president that actually started planting vineyards in America. And he fell in love with a French woman when he was circling around France. And in Haut-Brion, they used to ship most of their wine over to England, but the English could never pronounce the name. And because Jefferson was in love with a French woman, his French actually progressed quite well, and he could pronounce it perfectly. And they let him send a pallet to his friend George in New York, because we didn't have Washington, D.C. at that point in time, who was George Washington. And that was the beginning of the wine movement in the United States. So we have Jefferson to thank for that.
Yeah, that's very cool.
Now there's certain wines, certain styles of wines, certain brands in your portfolio that are more investment wines, i.e. that you buy them because they're going to age really well. You keep them 3 years, 5 years. I don't know. I'm imagining your cellar is got a few cobwebs in there for some of those great aged wines. Other ones need to be consumed a little quicker, i.e. the core being those ones that age well, the satellites being those short term, you buy it and you drink it. Give us some insight on that.
Yeah, well, that's a great point. I mean, because if you do want to be serious about investing in wine, it's important to have a good cellar. So in addition to buying the right wines to begin with, you need to take care of them. It's not like a stock or a bond that is going to, it's virtual or it's going to be kept in a vault. That is going to age well and you don't need to worry about it. Good wines can go bad. I've heard horror stories of people with wonderful wine cellars that got flooded, for example, because a cellar by definition is under the ground level and, shit happens. Every once in a while it can get flooded. So you need to look after that if you can afford it and if you've really gone upmarket with proper investment grade wines, then you would want to probably not even keep them on location, but keep them in a professional cellar, which will be managed. This is like a shore guard for wine, basically, but companies specialize in that, and for the right price, they'll deliver it to you within an hour if you decide you want to drink it, or if you decide you need to sell it. So that's the cellaring is really important, because there's all kinds of things can happen to wine. If it gets flooded, obviously that's not good. The labels should be kept intact, because imagine there's this paper label. The wine bottle and the wine inside may last for decades, but the label may peel off. And this has actually happened to people in floods, that the labels just sort of slip off. You don't even know which bottle is which anymore. That's a disaster. So you need to keep your wine properly cellared, and if you don't have a proper cellar but still want to have a couple bottles to play with, then you should at least invest in a wine refrigerator, which will keep it the perfect temperature and humidity, even above ground, and that's important.
It's brilliant, because there's so many analogies for the investment community with real life and fun hobbies like wine. Who could think of a better hobby to have, right? So thank you for your insight, Brandon. That's really, really nice and helpful, and it's always wonderful seeing you. I hope you're going to stick around. You might have a few questions. I see some of them coming through, so I think Kim's going to jump back in here and will moderate for us.
Yeah, thank you very much for that, Brandon. I think insights into wine, and especially how people can, it's a lot easier to think about that than investing in certain complex situations. But yeah, we'll be moving on to our Q&A section now, ladies and gentlemen. We've already got a few questions already in here, so we'll jump into that. And again, feel free to keep asking them as we dive through some of these questions. So we've got one from Nikita. If you were investing in ETFs, would you recommend diversifying, investing in ETFs with a sector focus or with a geography focus? So I guess Nikita is more referencing some of those sector ETFs that you have.
Well, I tend to find that if you buy geography-focused ETFs, you end up being sector-focused by the name of the game. So for instance, if you buy the S&P 500 or the KLD 400, which is what we prefer purchasing, you end up owning 23% of the portfolio in just the things Facebook, Apple, Amazon, Netflix, and Google. So yes, you're overwhelmingly invested in tech. Whereas if we buy most European portfolios, if you buy most European ETFs, you're going to be heavily weighted into banks and automotives. Well, the automotives have had a decent quarter, just because nobody wants to take the metro or such, excuse me. But essentially, you end up owning in certain sectors automatically when you jump into geographies. When we're buying geographies, we're buying them more because we like the currency than typically anything else. i.e., we have been overweight in the US dollar, in US securities for the last 10 years. Not just because we like the things, but because we love the dollar compared to the euro and the pound.
That's great insight there. And we've got another question from Rakesh or Rakshith, apologies on the name. His question is literally future of oil, question mark. Now that is quite the question.
Well, from the vantage point of hoping that the world will be around in the near future, I hope that oil prices will kind of disappear and be unnecessary. This will probably speed up now that we have a Biden administration that actually believes in climate change. There's these little things that can go a long way. So I would not expect oil to have a lot of prosperity. Now, I'm not by any means an expert when it comes to commodity markets. I'd say Cam is much more astute when it comes to that sector of the marketplace. So I go based on the simplicity that last November, Saudi Aramco, one of the biggest companies in the world, went IPO so that they could go ahead and diversify into different sectors. Now, they'll know more about the oil industry than everybody on this call combined, unless the sheik has joined us by some surprise. And therefore, what I would say is if they're selling out of their oil industry and letting us buy into it so that they can diversify into other sectors, I don't think that they think that oil prices are going back above $100. That's just how I would think about it.
Yeah, I think, you know, especially with oil and commodities, it's more of an evolving conversation, and, you know, there is no black and white answer because, again, I'm sure, Brian, you might be able to speak to this. You know, we have sort of 1 trillion infrastructure plans being, you know, tossed around, especially in the US lately. So, you know, we might see an uptick in commodities, and, you know, with this vaccine news that we've got recently, you know, demand will eventually pick up. But again, it goes back to what Brian just said. You know, if we have one of the biggest providers IPOing and making their exit, so to speak, you know, it doesn't generally bode quite well.
Exactly. We know that the commodity run was a lot based on China's aggressive buildup. They were buying commodities at any price. And what we should look at it now as we're talking about this change in currency regimes, that, you know, the renminbi is not going to become the global currency, but they're going to get a seat at the table. And when we look at that, with their Silk Road initiative, basically going all the way out west, and it's now entered into the G7. Now Italy's even accepting funds. Hungary, a European Union members accepting funds. So this is not something that's just on the periphery and, you know, the stands and through Africa, but they're going to be able to trade a lot of those currencies in their currency. They made those big investments to get those, and now they're getting a seat at the table because of it. And I don't think we're going to see a second huge rush of construction booms over in China. Could we see some growth more in some of the other periphery countries? Absolutely, as we always have. I think it was last year, 7 out of the top 10 performing countries in the world when it came to GDP were in Africa. We shouldn't be surprised. They're doing wonderful down there. There's plenty of opportunities in all those different places. And so the commodity boom will naturally be based on construction and building. But now, if we don't need to be in cities as much as we used to, do we need as many commodities as we did in the past? These are the questions to answer, but it's the amount of time that it takes them to rebound. That's the question.
Yeah. Brandon, this one's for you. We've got a question from Dan. What's the most accessible way to get into wine investments? Should you buy online or direct from the vineyard and from sellers? And also, could you recommend a good website for more information?
Yeah, sure, and thanks for the question. So basically, there are some public information sources. One of them is called winesearcher.com. So that's, I don't think there's any paywalls or subscriptions necessary to do that. And it's basically just a clearinghouse of publicly available, often crowdsourced information about wine prices and investments, from run-of-the-mill wines to very top-notch wines. I use another piece of software called Seller Tracker, which also is used for inventory management by wine sellers, wine vendors, restaurants as well. And there they will often compare the average value that people have paid for the wines in their cellars. So that's a good place to get some general market research on what a wine should cost. And then there's the wine media. So I subscribe to Decanter magazine, which every once in a while publishes articles on getting started in investing in wine, basic principles of investing in wine, and that kind of thing. There's Wine Spectator magazine and several others like that. So I would say the Wine Spectator and Decanter are probably good places to go to for basic advice. In terms of where to buy, the simple rule is try to cut out as many middlemen as possible. If you do have an opportunity to go visit the vineyards, visit the producer, and taste the wine, then you actually know what you're buying. And if you've done the research in advance, then you're buying also a blue chip or a brand name, and you know that investment will probably be good. Sometimes even in a bad year, because people don't realize it's a bad year, they'll just buy the name. So my principle of wine investing is try to have a little fun while you're at it, and either with an importer or a favorite dealer, or going straight to the producer, get a chance to taste the stuff before you buy it.
Perfect. Hopefully that answers your question, Dan. Again, it's more about the journey from what I got from it. We've got another question from Dalvinda. Again, this might be for you, Brian. What are the 5 best clean energy stocks worldwide?
Oh, so it's a wonderful question. Now, one of the problems with the clean energy sector is in the build up to the election, we saw clean energy stocks soar. I won't go through 5 from the vantage point of I know we have several more questions and I know we only have a couple more minutes left until the call's over. But one of my favorites is actually from the southeast of the United States, NextEra Energy. They bought the old Florida energy company, Florida Power and Light, and they are in a good position to be able to acquire other companies, get a lot of government funding for those, and otherwise be able to capitalize on it based on debt and rebuild a lot of the infrastructure that goes into getting the electricity from point A to point B, which America is well behind on that infrastructure spending. We've been using NextEra as one of our favorite positions, and if you want to be more diversified, the ETF FAN, their largest holding is NextEra. But it's a way of getting a basket of those. But I'm still U.S. centric, just because we know that the spending bill is going to be multiple trillions of dollars after this coming election.
Perfect. We've got a stream of questions now coming in, so we'll pick a few more before we end the call. We've got a question from Brandon. He wants some clarification on when you were going into the argument of, if Alphabet and Citi, or not Citi at this point, but if Alphabet, and which is more well known as Google, if they were broken up, if some of these larger tech firms were broken up, how would that, increase the selection, and why would that be good for some of these companies?
Well, simply put, if you talk to investment bankers, they will always start looking at a company based on a concept of a waterfall. So you think of a waterfall, and you'll have different valuations of the company. So I'm going to just use our company as a basis. When you have wealth management clients, over the entire industry, the average wealth management client sticks around for about 7 years. So you'll get the highest valuation for a wealth management firm. Now, we also have an asset management firm that other advisors can buy our fund selections. Well, because the minute that a portfolio doesn't do well, the financial advisor sells off the assets instead of saying that he was in the wrong asset mix, i.e. he blames the asset manager. The typical client only stays in a asset management company for about 3 years. And then investment banking is purely transactional. So you could get a huge deal this year, and then all of a sudden it goes completely dry. So if you're valuing a company, if you're valuing a large bank, the wealth management unit is going to have the highest valuation, asset management, middle, investment bank, the lowest valuation. So you start comparing, say, a historical investment bank like Goldman Sachs versus a Morgan Stanley who went out and bought Smith Barney during the last financial crisis. That's why a Morgan Stanley can have a lot higher PE ratio than a Goldman Sachs, because Goldman Sachs is getting more from the investment banking side. So we pull that in, you look at Alphabet in that same way, all of a sudden we know most of the revenue comes from the Google AdWords. But you go down into all these subset businesses, they're not in anybody's valuation of Alphabet. It's all based on the revenue, because most people are looking at that as a value company because it's making a good amount of revenue. A lot of those subsidiaries, if they were a venture capital company, you'd have large valuations that might be completely different from the current valuation of Alphabet. So you separate it all, and all of a sudden we'll be able to pick our winners from our losers, because we won't want to own all the different aspects. Same thing with Amazon. You look at their cloud computing, growing gangbusters. Well, what we think of Amazon as this delivery service, not all that profitable, because all of a sudden they're trying to kill everything on the margins. They're trying to get the full scope of everything. Plus, when we look at Mercado Libre down in South America, Allegra over in Poland, Alibaba over in China. There's competition coming globally, and they're all gutting after Amazon. So we love the cloud computing business, but we wouldn't necessarily keep the other side of the business if they were to be forced to break apart. I hope that helps.
Yeah, I think to quickly add to Brian's point, if we take the example of Google, they have a lot of these small projects or sectors that they're working on, which doesn't really get a whole lot of headline or traction in the main media. But as Brian said, if they're broken up, they're worth a lot more than just the parent company, because how many people have heard of the VR division over at Google or the self-driving division. A lot of these segments, if they're split up, they will attract excitement, and then that which leads again naturally to higher valuations. And then I think last question before we end our recording here, from Nikita again: is there a limit to diversification? Can you have your eggs in too many baskets?
That is a wonderful, wonderful question. The reason why is because it's something that has been debated for years. Now, I'm of the mindset that in the old era, where you didn't have, where you had trading fees, all of a sudden, having too many stocks in a portfolio becomes the complication and the cost of owning those stocks. Now, in the days of Robinhood, or where TD and all these other carriers are allowing us to trade for free, essentially the cost is no longer in the works, but it's what benefit are we getting by having too much diversification? Because we know when we take the S&P 500 over the last year for the crisis, if we just take those 5 stocks that I keep mentioning, Facebook, Apple, Amazon, Netflix, and Google, and we pull them out, they've had what, 20-something% return, if not more, in the last year, depending on where you start, whether it's just year to date or such, but they've had a wonderful return. Now you extract them, and you basically look at the other 77% of the index, and it's had a negative 1% return. So we want to be cognizant of what's going on, where we have it. We used to be a big advocate of the Russell 2000 instead of the S&P 500, just because it gave us access to small cap. The only problem is it removes our control when it comes to ESG. And I tend to think that the ESG viewpoint, and having a portfolio that you can be proud of, that you're not embarrassed that you make money from something that's destroying the world, is something that's at the core of most of our clients. First time we analyzed, we asked all our clientele if ESG was important to them, was close to a decade ago. And it was important to about 40% of them. It was very disappointing to me that it was important for so few of them. Now we're up in the 70 percentiles. So it's becoming more and more prevalent, and more people are basing that portfolio. So having 30 to 50 stocks, if you're doing individual stocks, to me is that gauge of being fully diversified to where you can own a good mix, but you understand what's going on, you're controlling costs, you're controlling the ESG factors, and you're accomplishing everything you want with a diversified portfolio.
Perfect. Well, Brian Dunhill and Brandon Michener, thank you very much for your time. I know we've slightly run overhead, and thank you to the audience for attending. Again, we'll be ending the webinar here, so thank you very much for attending.
Thanks so much for hosting, Kim. Thanks, Brandon. Great seeing you.
Yeah, thanks.
Looking forward to a wine.
Enjoy.